I believe in the next 10 years that the US dollar will lose about 75% of its purchasing power. It will do relative to other currencies, but it won't do well in the absolute sense. I saw this happen myself in the decade of the 1970s. In the decade of the 1970s, the US dollar lost 75% of its purchasing power. I mentioned this in this discussion because in the 1970s, the price of gold went up 30-fold. I'm not suggesting that the price of gold is going up 30-fold from here, and we could discuss why on another interview. But I do believe that the gold price will keep pace with the deterioration of the US dollar, which is to say, I don't think that gold goes higher. I think it goes much higher.
As confidence in fiat currencies continues to erode and sovereign debt spirals out of control, investors around the world are revisiting the role of real assets, especially gold, as a hedge against long-term monetary instability. The global economy is entering a slow-burning crisis, where inflation is no longer transitory, and central banks are trapped between tightening policy and sustaining unsustainable debt loads. In such an environment, gold doesn't just appreciate, it reasserts its role as the ultimate store of value. In today's video, legendary resource investor Rick Rule presents a sobering yet historically grounded forecast. Over the next decade, the US dollar could lose as much as 75% of its purchasing power, echoing the monetary decay of the 1970s. When a man like Rick Rule, with decades of experience navigating commodity supercycles and monetary crises, speaks with this level of conviction, it's not noise, it's a signal. He's not warning of some abstract macro trend. He's telling you what's already happening, beneath the surface, behind the headlines, the slow and steady erosion of your purchasing power. History isn't just rhyming, it's repeating. In the 1970s, gold didn't just appreciate, it exploded. And it didn't need a banking collapse or a war to do it. All it took was a breakdown in trust. Trust in fiat, trust in central banks, and trust in governments to defend the value of their currencies. Today, that trust is under siege once again. The difference? This time, the rot runs deeper, and the tools to contain it are running out. So when Rick says gold isn't just going higher, it's going much higher, he's not just making a price prediction. He's diagnosing a system in late-stage failure, a world where wealth will need sanctuary, not speculation, and gold is that sanctuary. If you're serious about preserving value in a world that's structurally designed to extract it, pay close attention. And if you find this kind of insight valuable, do what helps keep us going. Like the video, subscribe, and hit the notification bell so you never miss an update. Thanks, and enjoy the video.
I have a lot of liquidity. There is a lot of turmoil in the market. And while there's no guarantee of this, turmoil occasionally breeds real market panics. Turmoil occasionally breeds something like 2008. So mostly what I'm doing is I have a shopping list of opportunities that I'd like to avail myself of, companies in some cases, and I'm maintaining liquidity, looking to take advantage of that. I have a shopping list, frankly, of about 50 or 60 securities, as an example. And I have a nibble price, which is to say a share price that I would begin to establish a position in. And I have a gobble price, which is to say a price where I would really be an aggressive purchaser. On the other side of my portfolio, I have some speculative positions that I bought a year and a half or 2 years ago because they were really unloved. And I thought, well, I'm going to trade out of these things when they return to favor. So I'm doing that too. There are some companies that I think, in a speculative sense, are approaching their full value at this stage of the market. And I'm cycling out of those, looking for opportunities. So my portfolio is in flux. I would say that the dominant characteristic of my portfolio relative to many other portfolios is liquidity. I own, relative to the size of my portfolio, a lot of gold, and I have, relative to other portions of my portfolio, a lot of short-term cash, a lot of liquidity. But in addition to that, I believe that we're fairly early on in a gold bull market. I've lived through, this will be my fourth gold bull market, and they follow predictable patterns, Jesse. The metal moves first. When the metal has moved far enough, fast enough, that the gold price has outpaced the inflation in the inputs to produce gold, the margins in the biggest and the best gold companies move. You'll remember, Jesse, some frustration on the point of your listeners in 2003 when the gold price moved, but the gold miners didn't move. There were two explanations for that. One, the gold price moved because central banks were buying it. They don't buy gold stocks. The other was that the cost of producing gold was increasing as fast as the gold price. Beginning in 2024, the gold price accelerated faster than the inputs, and you started to see rapid margin expansions in some of the better gold producers. Two things happened there. They became worth more, but they got assigned a higher multiple too, as the narrative of the gold price extended to the gold miners. This occurs when you're usually about a quarter of the way through a gold bull market. So I suspect, if past is prologue, that we're a quarter of the way through this gold bull market. I believe, Jesse, that the cause of this gold bull market is primarily the deterioration in the purchasing power of the US dollar, particularly relative to the interest being paid on US dollar denominated savings, which is to say negative real interest rates. And I believe that that phenomenon will be with us for a fairly long time. Specifically, I believe in the next 10 years that the US dollar will lose about 75% of its purchasing power. It will do relative to other currencies, but it won't do well in the absolute sense. I saw this happen myself in the decade of the 1970s. In the decade of the 1970s, the US dollar lost 75% of its purchasing power. I mentioned this in this discussion because in the 1970s, the price of gold went up 30-fold. I'm not suggesting that the price of gold is going up 30-fold from here, and we could discuss why on another interview. But I do believe that the gold price will keep pace with the deterioration of the US dollar, which is to say, I don't think that gold goes higher. I think it goes much higher. And I think that that will expand the earnings of high quality gold companies, and I think it will expand the multiples that they're accorded too. I think the gold silver ratio is a factoid. I think it's a useful factoid for traders because so many people believe it. Something doesn't have to be true to be important. Uh, the gold silver ratio refers to the difference between the relative price of gold and silver and their relative abundance in the Earth's crust. People like it because it's an easy to grasp statistic, but I think it's pointless. It doesn't take into account, as an example, the cost to produce gold or silver. Most silver is produced as a byproduct of other metals, which means the production costs for 78% of primary silver production is kind of irrelevant. It's low, unlike gold. It doesn't go to utility either. My experience has been that precious metals bull markets follow predictable patterns. The momentum is established by gold because the first buyer is a fear buyer. When the momentum in gold has attracted enough generalist investors that they come into the narrative, leadership changes from gold to silver. Perhaps because of silver's relatively lower unit cost, perhaps because of its reputation, historical reputation for volatility. I don't know why, perhaps both. I just know that. When that happens, Jesse, you won't need Rick Rule to tell you it's changed. Those moves are generally very dramatic moves. So, in answer to the first part of the question, I'm overweight gold. I have a weighting in silver, but my suspicion is that we don't see a real rip roaring silver bull market for as much as a year or a year and a half. And it's a higher risk circumstance. I have about 2.5% of my portfolio in silver stocks. It wouldn't surprise me to see that become 20% of my portfolio organically with no with no additions. But it wouldn't surprise me either to see that move take place 2 years from now, 3 years from now, 4 years from now. I have the financial and psychological wherewithal to wait 2, 3, 4, 5 years. Many speculators don't. I also have the psychological makeup that I can stomach a lot of volatility. Small silver stocks can increase or decrease 10% in price as a consequence of the disposition of one institutional investor. They can go up or down 10 or 12% for no reason whatsoever. It takes a fairly large degree of psychological maturity as a speculator to stomach that volatility. I've had 60 years to learn that kind of patience. So I can do it, but many can't.
While Rule maintains significant gold exposure and reserves of cash, he's not rushing in. Instead, he's waiting, watching for panic to unlock deep value. This posture isn't passive, it's strategic. Liquidity, in his hands, becomes a weapon. His investment thesis hinges on the belief that we are still early in a new gold bull market. Historically, these cycles follow a predictable rhythm. Gold moves first, miners follow with explosive margin expansion, and then, sometimes violently, silver catches fire. As the saying goes, gold leads, silver outruns. When silver finally wakes up, it doesn't walk, it sprints. Rick's portfolio positioning hints at this sequence. While still overweight gold, he's quietly accumulating silver exposure, not for today, but for when sentiment turns and volatility rewards the patient. Meanwhile, amid growing uncertainty in the markets, systemic risks are becoming impossible to ignore. Recent analysis from renowned analyst Porter Stansberry paints a stark picture of the fragile state of the U.S. financial system. Bank of America is sitting on $700 billion in bonds bought at 1% yields in 2020, Stansberry recently noted in a social media post. Those bonds are down about 40%, hiding $100 billion in losses. Meanwhile, the Treasury needs to refinance $9 trillion and issue $2.5 trillion in new debt this year. Foreign buyers like China are dumping treasuries for gold. If Trump disrupts this debt recycling, we're staring at a failed auction, or Fed QE, that'll spike inflation expectations. When yields hit 7 to 10%, Bank of America's equity won't survive. A run on the bank? ATMs down? It's not if, but when. Fractional reserve banking fails, it's built to. See 1932. This warning sets the tone for the deeper insights Rick Rule shares next about market vulnerabilities and potential catalysts in precious metals. Let's get back to the video.
We've gone through a period, 1982 to 2022, that were the most benign economic climate in human history, particularly for Americans. Real and nominal interest rates were falling. The U.S. dollar was strong, so we could export inflation. The benefit of demographics, which is to say the baby boomers, the benefit of global trade liberalization, a wonderful time. All that's changed, but I don't think that investor perception has changed. I think that we've been schooled through 40 years of benign times to be probably more aggressive, more positive than we ought to be. In the near term, with regards to Bank of America, as an example, the regulators, in their wisdom, have allowed Bank of America to say that those obligations aren't being held for trading, they're being held to maturity. And if they will pay off, that they can value them on their balance sheet, not at market, but rather at par. And I believe that not one investor in 20 knows the difference between mark to market. It's a legislative sleight of hand that people don't care about. The last time I saw people care, personally, was 1973. And that was an interesting change of circumstance. I don't know if the change of circumstance will occur. I happen to believe that the U.S. government will be able, in the near term, to roll over its debt, because I believe that the American people have looked at quantitative easing, that's Fed speak for counterfeiting, is a good thing. That's how you manage an economy without any pain to individual voters. It reminds me of the Hemingway quote. I'll only paraphrase it because I don't remember it. How do you go broke? Gradually at first, then all of a sudden. It becomes a problem when it's perceived to be a problem. I can tell you this. I'm delighted to be starting up a new bank that has no long bond portfolio, when so many of our competitors that might otherwise have competitive advantages over us with established banking relationships have real, true balance sheet constraints. The problems that I discuss in my work, $141 trillion in private net worth in the United States against $130 trillion in net government debt, is a problem over a decade. What Porter describes probably is a problem over a decade. I think what investors need to focus on, and speculators too, is the fact that the way out of the dilemma described by Porter and the way out of the dilemma described by Rule is to reduce the purchasing power of the US dollar. You reduce the aggregate net present value of the debt while honoring the nominal value of the debt. In the decade of the 1970s, according to the Office of Management and Budget, the US dollar lost 75% of its purchasing power. This isn't a number put up by some cranky old libertarian named Rick Rule or a young copywriter, great thinker named Porter Stansbury. This is the Congressional Budget Office. By doing that, we devalued the net present value of the obligations run up by the war in Vietnam and the war on poverty. We got through it. It was ugly. There was a reckoning to get through it. Interest rates quadrupled. It was not a pretty time, but we got through it. And we're going to get through this too. Investors need to be concerned because we're heading into this period of turbulence with on-balance sheet and off-balance sheet liabilities in a real, not a nominal sense, that were 4 times as high as they were, which is to say there's less string to push. But we're also heading into it with a society that's enormously richer and more competent. If you look at the gains in technology and efficiency that we've enjoyed since the period of the 1970s, this is still a time where a bunch of young kids can commandeer a garage in Sunnyvale, and out pops Google or out pops Apple. That does 2 things. It makes a bunch of folks rich, but it also lowers the cost of doing business. It makes the solution to global problems less capital intensive. So we'll get through this, but it ain't going to be as easy as getting through the last 4 decades was. I think it's important to know that. I think it's important, too, that people understand one solution to this problem, 2 solutions perhaps. Despite the fact that your savings reduce your wealth, despite the fact that you're being paid 4.2% in a currency that's depreciating by 7.5 or 8, you have to keep liquidity anyway, because in a circumstance like 2008, if you have liquidity, you take advantage of the situation rather than being taken advantage of, by it. The other thing that you need to do is, if history is a guide, you need to have part of your wealth stored in gold. In the decade of the 1970s, when the purchasing power of the US dollar fell by 75%, the gold price increased 30-fold. I'm not suggesting that the gold price increases 30-fold from here. It's already up 12-fold from the year 2000. What I'm suggesting to you is that the gold price likely increases in proportion to the deterioration of the purchasing power of the US dollar over 10 years.
The economic challenges ahead are serious. The erosion of the US dollar's purchasing power, rising debt burdens, and financial system vulnerabilities. But with risk comes opportunity. Rick Rule's insights remind us that gold remains the ultimate sanctuary for preserving wealth when trust in fiat currencies falters. History shows us that during times of monetary crisis, gold doesn't just hold value, it outperforms. If you want to protect your purchasing power and position yourself for what's coming, consider these lessons carefully. Stay informed, stay prepared, and keep your wealth grounded in assets that withstand uncertainty. If you found this analysis valuable, please like, subscribe, and hit the notification bell to support the channel and never miss an update. Your engagement helps us continue to bring you critical financial insights. Thank you for watching, and stay vigilant.